Okay, good afternoon, everybody. Let's go ahead and get started. Just want to welcome everybody here. Want to give a shout out to those of you watching this in the recording. Want to say hello to you guys as well. I'm looking forward to this webinar. This is basic training today, Monday. We do a basic training call every day on the calendar at 2 p.m. Eastern. Just covering yeah, like I said, just basic training material. And today I want to talk about risk management. And we're going to do, it's one of my favorite webinars, actually. We're going to go over different risk management scenarios. I'm going to show you different tools that you have with risk management. So how to manage your risk and really want to open your guys' eyes up to the different styles of risk management, because risk management makes and breaks your strategy no matter how good your your style, no matter good your edge. It really doesn't matter unless you have a solid risk management structure. Okay, so let's go ahead and get started. Before we jump into our instruction for today, as always, I need to remind you guys about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is, and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys. So let's talk about why we manage risk. Okay. So this should be pretty obvious, but there's um, um, some specific things that I think I want to cover with you guys. So the number one thing that we do is we preserve capital. I think Warren Buffett said the number one rule of trading and investing is to not lose money, and the number two rule is to not forget rule number one, right? So preserving what we already have is key in trading. So even before making money is just keeping what we already have. And we also know that we do have to risk money in order to make money, right? So obviously, we're going to be doing that, but it's a matter of our approach, right? So if we're using a stop loss and if we're using a lot size calculator religiously, you're going to have a much better chance of not losing what you already have. Things like having a max stop out, max drawdown, personal drawdown. You know, a lot of prop firms have max drawdowns. If you have one for yourself, that's going to help as well. Um, right? Because what a lot of new traders do when they first get started, I was guilty of this, is when I would take trades, I would, like my first couple of years trading, I'd get pretty confident with the trade. And so I'd add to the trade. Like if it went against me, I'd add more and add more and add more to it with the idea that if the market turned around, I would get all my money back. Well, that works when it works, but when it doesn't work, it's devastating, right? So, there's been a few circumstances where I've added into a position that just keeps going against me, and I ended up losing a lot of money, right? So these are the types of retail trading styles that we have to recognize early on and just commit now that we'll never participate in them, no matter how attractive they come, no matter how confident you get with a setup or particular trading style. We just have to have that. We have to have that commitment to never do that. Okay, so that will help you with your long-term sustainability. It will help you with your emotional control because you'll have a game plan going into the trade, mitigating unexpected events. And the last, the risk of ruin. Risk of ruin is huge because what happens is if you draw down a trading account way too far, um, basically it makes no sense to grow it anymore. So let me give you an example of this. So I heard Ray Dalio, he's one of the biggest hedge fund managers in the world. He said, and this is just math, he said if you lose 50% of an investment, let's say you invest $100 into something and it's only worth $50 now because it lost 50%, you now need to make 100% return just to get your money back, right? So this is a concept that just like blew my mind. Like it's so simple, but like when you really think about it, it makes so much sense why we invest the way we invest and why we trade the way we trade. Because yeah, if you get to a certain point of loss in trading, in order to make the money back, you need an absurd return to get back to where you need to be, right? So this is why we try to stop. This is why when we take trades, we risk 1% or less per trade. Many times it's less than 1%. The max is usually 1%. Um, let's see, just because you don't ever want to get even close to having to deal with that kind of capital loss, right? It's just too devastating at that point. This happened in 2008 with the stock market. Stock market fell 55% from its all-time high. So from whatever high it got to in 2008 or 2007, by the like 2010 or 2009, when it hit its low for the last couple of decades, after the great financial crisis, um, it fell 55% from its top, right? So it took years to get back, right? It took a long time. I think it took actually until, I could be wrong on this, but it was like between 2012 and 2013 or 2014 when people actually got their money back. So if you had invested at the very top of 2008, and you'd have to wait until like 2013 or 2014 just to get your money back, right? This also happened with the Great Depression. This one was the most extreme example of this risk of ruin concept. So in 1929, the stock market went to an all-time high at the time, right? It was the roaring 20s. Things were going crazy. Things were going great. And then things collapsed pretty quickly into 2029 in like September and October. And with it, the U.S. economy went into a recession, or not a recession, a depression. And it didn't bottom out until 1931. So in 1931, the stock market from its all-time high. So if you take the tippy top of 1929 to the bottom of 1931, it's an 85% difference. So if you had invested, let's say you were the most unlucky person in the world, and in 1929 you put $100,000 into the stock market, and if you had just looked back at your account in 1931 at the very bottom, that $100,000 would have only been worth $15,000. Okay, so that's the concept of risk of ruin. Guess how long it took to get your $100,000 back to break even? Would have taken you all the way until a little past World War II in 1948. So if you had invested 100 grand in 1929, okay, it would have taken you until 1948 to get your 100 grand back. All right. That's actually, people got burnt so badly during that time that people decided not to invest anymore. Like they were like, I'm not going to invest in that thing. That thing lost all my money, right? I'm not going to do that. So that was a pretty extreme example. Could it happen again? Sure. If history repeats. Am I saying it's going to? No, I'm not. I'm not making any predictions here. All I'm trying to do is just illustrate the point of this concept of risk of ruin, because it took practically no time for people to lose all their money in the Great Depression, and it took 2 decades for people to get their money back, right? Nearly almost 2 decades. It was like 18 years or 19 years it took for people to get their money back. And my guess is most people probably took the loss because they probably needed the money just to survive. Very few people probably had the ability to invest more or even wanted to invest more when things had hit a bottom in 1931, because that honestly would have been a great time to invest so long as you could have held. In hindsight, obviously now we look at it and like, yeah, if you were alive and had the ability in 1931 to buy a lot of stock, that would have been great. But nobody was really thinking that at the time. Everyone was like, oh, I lost all this money. But this is the point of risk of ruin. So nobody had a stop loss on their trades, right? And that's what's so cool about what we do is we have the ability to manage risk. You can stop out. You can have a game plan. You have a lot of controls and responsibilities with how we trade.
Hey traders, it's Steve from the future. I hope you have enjoyed this video so far. If you are getting value out of this video, be sure to hit the like button, click the subscribe button, and share your trading thoughts. I read all the comments, so feel free to ask any questions you have there too. On a side note, I host live trading calls like this one you are watching every day. Some of my biggest trading secrets I share exclusively to just the members in my program. I host these live trading calls every day, Monday through Friday at 11 a.m. Eastern. I also host a basic training webinar every Monday for the newer traders and the regular COT report and sentiment trading webinars every Wednesday night at 8 and 9 p.m. Eastern for the advanced and aspiring traders. All of these calls are recorded and promptly posted on the members' trading calendars at the conclusion of each call in case your schedule does not permit you to come to the live call. All of my members have complete access to the scanner. We call it Steve Scanner. This is an institutional grade trade alert scanner that picks the direction of the week on all 28 major currency pairs and includes trading instruments like gold, silver, NAS 100, US 30. Just in the last 90 days, I have made over 3,000 pips just taking the top trade signals from the scanner at the beginning of the week and then just holding those trade alerts until Friday. If you want access to the scanner, you can start a 14-day free trial with the join link in the description to get started. Lastly, if you really want to be a full-fledged VIP member of my program to get access to things like the basic training course, live signals channel, Steve's scanner, trading calendars, and the one-on-one calls with me throughout the month, you can use code YouTube50, that's YouTube50, no spaces at checkout, and save $50 on your first month. Again, just click the link in the description below and apply that coupon to become a VIP member, and I look forward to helping you with your inevitable trading success going forward. Now, back to the video.
All right, let's move on. So I don't think I need to talk too much about this. I have a different webinar on martingale, so I'm going to skip this, and that's not really what I wanted to talk about today. So I'm going to skip this slide. I think I'm also going to skip grid trading systems because that kind of goes with martingale. But usually these are systems that a lot of algorithmic trading styles or trading robots use. It's a style of risk management, which, if not used correctly, can be the how you ruin your trading account. Most people who ruin their trading accounts use some form of martingale or grid systems. At the same time, though, I will say that I have discovered that there are plenty of people who have been trading a long time who use a form of martingale, and if they do it correctly and they've put limits and guardrails on how they do it, they actually make quite a bit of money. So it's just something we don't need to talk too much about it today. We have other webinars on martingale and grid systems, but I would say for most retail trading styles, these are pretty toxic. And if you trade the purest form of martingale, which is basically just doubling down after a losing trade, you will find yourself in a ruinous state at some point. So usually try to send people away from these styles, but I want you guys to be aware of them. We have, like I said, I've got other webinars I can send to you that talk about these styles in more detail. Today, I want to focus on this, and I want to get into these scenarios here. So we're going to go back to this. This is risk management tools. So what do we have in our toolbox, right? So much in trading we can't control, right? Every wise person you've ever met had probably told you, control the variables that you can control, right? Sometimes people, including myself, I'm guilty of this. I let things that I can't control my mood, but I'm getting better at that. I'm learning that, hey, there's literally nothing I can do. If there's something I can't control, like other people, can't control other people, right? If I can't control what people do, then don't worry about it, right? Maybe something happens with the weather, can't control the weather. So my attitude towards the weather needs to be different, right? So I have to be different despite maybe some of those other variables, right? But what can I control? Well, I can definitely control what my thoughts are like, right? Like when there's bad weather or something, just as an example, I can control my mindset, right? I can control, like with trading specifically, things that I have control over are where I get into a trade. I can control how I exit a trade, whether that's for profit or for a loss. I can have control over that. I can control what pairs I trade and which pairs I don't trade. I can control the timing, like what times of days I trade on, what time frames I trade on. I can control which prop firms I go with, which brokers I go with, right? There's a lot of things you can control with trading. Obviously, you can't control the market, can't control exactly what it does. You can have an idea of what it's likely going to do, but at the end of the day, it's not going to do exactly what you think it's going to do, right? Okay, so as far as managing our risk, we have the stop loss, right? That's like the number one tool in your toolbox to manage risk, right? A lot of people, especially when you're newer to trading, get this idea that they don't really want to use a stop loss. And the reason why people avoid this topic of using a stop loss is because it's painful, right? If you use a stop loss, that means that you're admitting that you could be wrong on a trade. And that's very hard to do. Sometimes it's really easy to get proud with our opinions or our ideas about things, or maybe we get too excited about a trade and we're like, there's no way this is going to lose. I'm not going to use a stop loss, right? And so sometimes our own hard heads get in the way of our success, right? I've noticed this. Like, have you ever gone on like a Reddit board or Facebook board or Quora, or you try to go comment on an Instagram post or YouTube, and you see people's comments after comments, and people are fighting with each other, trying to be right. And sometimes, like, we just have this like innate desire to be right over being successful, right? Which is kind of weird. It seems like it'd be the opposite. Like you'd almost rather be successful than be right. But it's been proven that people just have this innate desire to be right all the time, even if, and it's just like a defense mechanism. Sometimes people want to defend what they have, you know, maybe that's even a political belief or something. Like people want to defend that. I don't want to talk politics. I'm just trying to give you an example that people defend what they have, right? So if you're trying to defend what you have so much, sometimes you defend it even when you're wrong. And so that's the hard part in trading is you have to be able to look at something objectively and be like, I'm just flat wrong here. And that's the whole point of a stop loss is admitting to the fact that you're wrong. The faster you can be wrong about something in trading, the better off you'll be because the sooner you'll be on track to the next winning trade, right? So that's why I'm saying it's very difficult. Like I've noticed, like for me, this has been a struggle because I'm pretty hard headed and some of my beliefs and things like that, um, and so I've noticed this is kind of a struggle for other people as well who have kind of the same thought process. Like you're pretty convinced about whatever. And so when you get super convinced about something, if you're not willing to maybe open yourself up, then that usually that type of person struggles with trading from at least a risk management side of things. I've noticed they struggle because they're not willing to be wrong. Like I said, one of the best things you can do as a new trader is being able to admit the fact that you're wrong faster. Like I said, when I first started to trade, I'd get so convinced about a direction that I would get so convicted that I'd marry the trade. Have you ever heard that phrase before, marrying a trade? Yeah, if you haven't heard it yet, you'll definitely hear it later as you study and watch videos. But yeah, we don't want to marry our positions, and because we got to get rid of them. They're temporary. They're only to help us make money. So if they're not making us money, we got to get rid of them, right? So, and that's the whole point of a stop loss, right? Trailing stop is another thing to help us along the way, right? Like this is another variable that you have control over. You can decide whether or not, um, you can decide if you want a trailing stop. Um, a trailing stop, basically what it does is it follows the market. So if you take a trade and it becomes successful, it makes your stop loss move up. Okay, so let's say you take a buy on, like, say, the Aussie CAD, like we have this week. That's one of our top buys, and it starts to go up. Your trailing stop cuts that risk down. Okay, that's a thing you control. Does it have its pros and cons? Yep, like everything. You have opportunity costs literally with every decision you make in the market. If you choose to go long, you can't go short. If you choose to use a stop loss, you're not gonna have the option to not have one. If you put in a trailing stop, then you're not gonna have one, right? Like the opposite is like not having one, right? So there's always opportunity cost. So you have to kind of determine what makes the most sense for what I'm trying to do. Um, Okay. And then I would say, so trailings, we don't do a lot with trailing stops, so I wouldn't worry too much about it. Like a year ago, I was really into trailing stops for a while. But then I noticed that a lot of the trades that I would take would get whipped out too early, especially with the weekly trades. This is like a year ago. So I kind of went away from the trailing stops, except we'll move stop losses manually if there's like a big news event midweek or something. We'll move them to break even after they've already gone up big time in our favor. Right. Okay. So there you go. So and that's another risk management tool that's not listed here. It's just your own ability to scope out the market and move your stop loss. Last thing I'll mention here, um, is the Forex position size calculator, right? I don't know any other group. I don't know about you guys if you've been involved in other groups before, but I feel like our group is probably, from what I've seen, because I've been in other groups, and I'm still part of some other groups, but nobody emphasizes the position size calculator like we do. And I know a lot of people when they're new, they're kind of reluctant to use it because they're like, I've never used one before, Steve, so I don't know if I want to use it. But I'm just telling you, like, this is your way forward because this keeps you accountable, it keeps your trade accountable. It makes sure that when you take a trade, you're risking the exact amount that you can that you're supposed to risk. We have a luxury in Forex. If you think about it, when we take contract sizes, you can do micro contracts. You have a full standard lot at 1.0, then you have mini contracts, which are 0.1s. Then you have micro contracts at 0.01, right? So we have the ability to structure our trades and calculate our lot size to the very lot size that's perfect for our risk management. You can't really do that as well if you're trading like options. When you buy options, you have to buy 100 shares. You can't do fractional, at least I'm not aware, can't do fractional options at most brokers. Okay, so if you want to buy an option on Apple, you have to buy a full option, which would be 100 shares of Apple, right? Like if you want to buy um, like yeah, anything doesn't matter if it's a penny stock, it's a little easier because the price isn't as much, but if you want to buy a big stock and options on a huge corporation and their share value is pretty high, like if their price per share is pretty high, you may not have the funds necessary to manage that trade. So I've noticed a lot of people burn themselves in options pretty often. And I know a lot of people have had a lot of success too, but I've noticed the average trader struggles with the options because in the stock market, because I think it honestly goes back to their risk management. I don't think they're managing risk. I think most people I know when they buy options, they'll tell me more about like why they took a trade. Like I knew a guy he just last week told me that he bought some options on like some airlines back in 2021 when people started to fly again, 2022 when they started to fly again, and he did really well. So they're more anxious to tell you about how they were right. Again, this goes back to the concept of being right, right? People are more anxious to tell you about how they knew about something rather than like the mechanics of how they protected themselves in the process because nobody really tells you that part, especially if they lose. They're never going to tell you that they lost, right? Um, so so as you can see, this is a really passionate topic for myself because I feel like this is the thing that keeps everybody safe. I don't know, really know of any traders that blow up their accounts if they're doing this. Can you lose money? Yeah, totally. You can definitely lose money. This is not like a surefire way to make you profitable. Um, I wish I could say that. I'm pretty close to saying that, but not quite. I think if you follow the trades, I think if you take the weekly trades and you do this, I will say that you'll be profitable. Yes, but you could still lose money, and definitely on a day to day basis or a week to week basis, you can still lose money. But I don't see any way you could blow up an account, right? Which is really, like I said in the last slide, that's the risk of ruin is kind of like the thing that you have to avoid. The reason why you have to risk ruin, you have to avoid ruin, is because if you do that, you blow up an account. It's very hard to want to come back to trading, right? Some people, like I can't tell you how many times I talk to people who, they think about joining the program, but maybe 3 years ago they put 50,000 or $100,000 into an options trading account, and they lose half their money or more than half their money doing some option gambling or something like that, right? Um, and again, they had a hunch about a trade, and that's all about they can tell you, but they never had anything as far as a stop loss or position size calculator, right? So anyway, really important stuff. So we got to control the variables we control. I love this comment here. Paul says bad news early is good news, right? So like this goes back to what we were talking about earlier. Sometimes if you can see a trade's not going to go the right way, um, cut it, right? Like, but take the pain now because the scab that you have right now is much better to put a band-aid on. You don't want to, fix your wound with a big piece of gauze or something like that because the bleeding was so bad, right? Everything has to be within the amount that we're willing to risk. Absolutely. All right, guys. So let's move on to these scenarios. So this is the part I really wanted to cover. I wanted to open up your guys' eyes to this. Maybe a lot of you guys maybe have seen this before if you're live or, well, I don't know. I actually don't know if everybody's seen this, but um, and also this is also for those watching this in the recording. So hopefully you guys can get something out of this where this will make sense to you. But I want you guys to see what it takes to be profitable. Okay. So here's scenario number one. This is a trader who takes 1-to-1 RR ratios. This is your risk to reward. So many people, when they ask me, I talk to people every day. Sorry, guys, I'm getting calls right now. I've been sorry. And a lot of you guys have been trying to call me too, but I got to turn off my phone. Sorry. Just getting blown up here. Anyway, let me finish this topic. So a lot of people, when they call me or when I talk to people on the phone about joining the program, the one question I get asked all the time is, what is your win-loss ratio? And this is a great question to ask. It's not a bad question, but the amount of times I get asked what my win-loss ratio is over what my average win to average loss ratio is so crazy. Like 10 times more often I'll get asked, what's your win rate? Right. And like I said, it's not a bad question. You should be asking those types of questions when you're trying to judge how a strategy works. This is the same thing when I go out and evaluate trading robots, which we have a class, by the way, this week on Wednesday. We can discuss some trading robots. I have to evaluate what the win-loss ratio is on a trading robot, but equally as important, perhaps more important, but I'll just say it's at least equally, is the average win to average loss. Okay, because they go hand in glove together. You can't, it really doesn't matter what your win rate is if you don't know what your average win to average loss ratio is. You're going to see that here in these scenarios. So let's start with number one. So, number one here, we have the average win loss ratio or average win to average loss at 1-to-1. This basically means that if you risk $1, you're making $1 on those trades. Okay. And let's say that your win rate is 50%. Okay, so they go together. You have to talk about these two risk management variables together. They really doesn't make sense to talk about one if you don't talk about the other. That's why I say they're equal. So if you take 100 trades at a 50% win rate with a 1-to-1 RR ratio, you're breaking even, except you might be losing a little bit of money because you still have to pay for the spread and commission with your broker, right? But it's essentially break even. Okay, so this is actually, surprisingly, this would actually be better than most of your average Joe traders out there. Just a 50% win rate would be okay, right? Okay, that's pretty straightforward. Let's go to scenario two. So this is a 1-to-2 RR ratio. An example of this would be if when you take your average trade, you have a 10 pip stop loss and a 20 pip target. Okay, this is not bad. This is not bad because you're trying to make more money when you win and you're losing about half that when you lose. So if you take 100 trades and 50% of them, so 50 trades win and the other 50 lose, at the end of those 100 trades, you will have made a gross of 1,000 pips in gains. That's your gross gain. And then you will have lost a gross 500 pips. And that would leave you with a net of 500. So 1,000 pip gross gain minus a minus 500 gives you a net of 500 pips. Now, this is the thought process right here. I want you guys to think about this. You only need a 33% win rate to break even. Okay. So obviously we want to make money, but breaking even is the beginning, right? Capital preservation. That's the first thing we mentioned in the first minute of this webinar was capital preservation, right? That's the number one rule that Warren Buffett says, right? Number one is don't lose money. Rule number two is don't forget rule number one, right? So capital preservation's at only 33%. That's fantastic, right? That's great. You only need to be right a third of the time. Okay. Let's do scenario three. This is the gold ratio right here. This is the one that I try to aim for. We try to do, and some trades will do better. Like we took a trade this morning on the CAD yen that, when it triggers later this week, we're trying to make 4 times what we're risking. So that one's actually a little bit better than this one, but this is like the gold ratio. Try to get your trades about here. Okay. Whenever you're taking price action trades, just be pretty much around this area. So like if I could do a plot chart on all your trades, I want to see that your RR ratio is pretty dang close to 1-to-3. Sometimes better if you can get better, great. And I'm okay if you take a few 1 to 2s. I really don't want you taking 1 to 1s. 1 to 1s are everywhere and they're kind of a scam in my opinion. So try to get 1 to 2, 1 to 3. 1 to 3 is ideal. And then 1 to 4 and 1 to 5s on the occasion that you can find them. They're tough to find and they're hard to fulfill, but they are around. You can get 1 to 4s and 1 to 5s definitely. Okay, so an example of this is if you had an average of a 10 pip stop loss and a 30 pip target. So if you take 100 trades and you won 50% of those, which is actually really, really good, just a 50% win rate, you're losing half your trades, but you're winning the other half as well. You would make a gross of 1,500 pips in gains and minus 500 pips in loss for a net of 1,000. That is fantastic. Like if you can do this, you are in the top 5%, top 3% of traders. And it's funny because that's all it is, right? Like it's not, this isn't rocket science. This is just a quick, simple math. And it's just finding the opportunities out there in the market that can provide 1 to 3 RR ratios and so on. Okay. You only need, again, listen to hear your thoughts out when you think through this math here. Just to preserve your capital, you only need to win 25% of the time. That's amazing. You could take 4 trades, 3 of them lose. You could lose them all in a row. That's fine. And on the fourth trade, you win at a 1 to 3. All of a sudden, you're back to break even. Okay. This is the golden ratio, 1 to 3. I don't know why it's just the 1 to 3 is everywhere. You can practically find these every day on almost any different time frame and on any different instrument that you want to trade. But like they're so common that you should be able to do this. Like 1 to 4 and 1 to 5s are still pretty common, but I wouldn't say we get them all the time. Like we did a 1 to 4 on the CAD Frank last week, and that was great trade, but they are kind of a little bit harder to come by. But yeah, the 1 to 3 is always available. Okay, let's move on to scenario 4. Okay, this one's a little bit of an opposite scenario. This is a 3 to 1 RR ratio. So this means that you're risking 3 units to make 1 unit. So you're risking $3 just to make $1. Now you might ask, why would anybody do this? And here's the funny thing, most people do this. Okay, this is like your most standard. In fact, this is probably the most standard scenario for 90%, 80 to 90% of traders out there. Okay. So it's funny because you guys have seen the gold, you guys know what works. And then you come here and you're like, why would anybody do this? Well, now you're being taught correct principles. But like I said, 80 to 90% of traders, this is their style right here. So 3 to 1, that means you're risking 30 pips to make 10. So if you take 100 trades and you win 50% of those trades, you will make a net or a gross of 500 pips. But here's the problem. Those other 50 trades would lose you minus 1,500 pips. So you'd have a net loss of minus 1,000. That's pretty bad, right? And the more absurd part about this is you need a 75% win rate just to break even. You're not making money. That's not covering the spread. That's not covering commissions. That's just hopefully you're breaking even at 75%. Okay. So you got to be so darn right about your trades. Like you just got to be so spot on just to get that. So it's funny because we look at this, you read the math makes sense, and you're like, why would anybody do this? But like I said, this is like what people do, and this is why people lose money. So, and that's what's crazy is like somebody could go up to you and tell you on the phone and be like, yeah, I win 70% of my trades, or I win 60%, and you'll be like, that's pretty good, 70%. I'll take that. I'll take that deal. But then they don't tell you what their average win is or the average loss is. And all of a sudden you find out that that 75% win rate is actually a losing strategy. But then there might be another guy who he only wins 40% of his trades. Okay. He's losing 60% of the time, but his average win is 3 times bigger than his average loss, and he only wins 40% of the time. Well, he's a super profitable trader, but the guy who makes 70% of his trades, he's actually an unprofitable trader. So that's why I say you got to ask both details when you're evaluating a system, right? And I do this all the time on, oh, sorry guys, I'm getting called again here. Apologize. But yeah, so yeah, back to my thought here. you got to ask both questions. You got to figure out like, okay, you got your win loss ratio, which is really important, but just equally important, you have to ask what's your average win to average loss ratio. Super duper important. Then you've got and so like when I look at trading bots, again, we're going to do this a lot this Wednesday. We're going to evaluate some different bots and so on. And if you guys have bots you want me to look at, send me those bots so that I can evaluate them in time to get them added to the slideshow for Wednesday. But yeah, when I'm evaluating different systems that I want to subscribe to, I'm looking at both details because there's a lot of information you can get about the type of style of trader that they are, depending on what they prefer. Do they prefer bigger wins or do they prefer more wins, right? Definitely want to know between the two. Okay. I'll give you, let's see, do I have a fourth scenario? No, I don't. Okay, so the fifth scenario. So the fifth scenario I was going to give you, I'll just give it to you over audio here, is like, I remember I was presenting at a conference in San Francisco several years ago, and I had just gotten off stage. And when I came down, this guy, I remember hearing this guy talking to this other trader. They were both visitors at this conference, and this guy, I don't know what he was thinking, but he said he told this trader who was kind of unsuspecting, like, if you only risk at just two, if you risk 100 pips per trade with an average take profit of only 2 pips, you're going to win every single trade. And so his theory was if you just win, if you just put a 2 pip take profit on every single trade, you're going to win most of those. And he's not wrong. The problem is that you're not going to be profitable at that because there's going to come a point where you're going to get a trade backwards. You're going to be wrong, in fact. And when you get that trade wrong, it's going to be so wrong that the average loss of said trades will surpass any profits you made in the past. So you could have a 90% win rate and still lose a ton of money. You could have a 95% win rate and still to lose a ton of money, right? Um, I actually have this bot that I put together like 5 years ago. It actually I had a guy in Morocco put it together for me. It has a 7% win rate. The thing makes money though. It just makes money. It goes down to the fact that the average win when it wins is just so insane that it just covers any losses. Now I don't use it as much. I need to tweak it though because I don't like being at a 7% win rate. I'm not saying you should do that. I don't recommend that. You should have a higher win rate than 7%. But I do want to normalize this. There's nothing wrong with having a 35% to 50% win rate so long as your average win ratio is 1 to 3 or 1 to 4, 1 to 5. Okay, there's nothing wrong with just winning 35% of your trades or 40%. 50% sometimes is amazing. Like, let's normalize a 50% win rate so long as that trader is really good with their average win to average loss. If they're doing that and they're at winning 50%, I'd subscribe to that. That's a great signal. That's a great strategy, right? Okay, cool. Any questions about this? By the way, quick thing. I'm going to wrap up this webinar here. Paul, I know you had some questions today. If you want to stay on after this webinar, that would be great. After I get done with the recording, I'll open it up because I know you had some questions. So just stay on. We'll do that. But any questions about this? I really wanted to cover this because I just feel like a lot of programs out there, they don't tell you about this part. And it's such simple math. And if you just get this concept, you'll be successful, not only in trading, but like if you approach your other investments and other things that you guys want to get into this way, you'll make a ton more money. I tell people this about real estate too. Like it's all about how you get into a trade because get into a purchase. Like if you buy very well in the beginning, it makes your exit so much better. But if you don't get a very good beginning, it's very hard to get out. You can't get that win loss rate or that average win to average loss ratio that I'm talking about, right? So that's why in these live trading calls, we do these we look for areas that provide 1 to 3 RRs, 1 to 4, 1 to 5. and we're patient to wait for the market to come to us. We're not going to force a trade just because we have the itch to take a trade and click the mouse and get into an opportunity. We don't do that. We wait for the market to come to us, then we go in, right? That's what I want to put together. So I want you guys to understand, if you get that concept, your trading will excel and you'll be a great trader. So, all right, guys, I'm going to go ahead and wrap up. Appreciate each one of you. Thank you for coming. Have a fantastic rest of your day, and we'll see you guys in the next webinar. Thanks for coming.